So in this video we're moving into the final component of private capital, private equity, actually private debt, which is not the same as private equity, but it belongs to the same learning module. Private debt is basically debt provided directly to private entities, although I don't really like this definition too much. This is what your book has. I don't think it's that accurate. What we have to add here is that it's debt provided also outside the typical, traditional structure of banks providing loans to private companies. Well, private debt has grown significantly following the 2008 financial crisis, because after that crisis many financial institutions faced restrictions and curbs on their borrowing. There was demand from companies to borrow money for loans, but the banks were less able to do so due to various constraints, regulatory constraints, capital constraints, and hence the gap between the demand side, companies wanting to borrow, and the supply side, banks not necessarily being able to or willing to lend, has increasingly been filled by lenders, so-called private lenders. So this is private debt. This may happen, when the lenders do the lending directly or via a fund that specializes in providing these loans. What you've got to, what you may, I think, most likely be examined on are the types of private debt. And that's what I'm going to focus on here. Types of private debt. Right. The first one is what we call venture debt. This is very much like venture capital. It's debt provided to startups, early stage companies. These companies have, as we know, no or little cash flows, as in positive cash flows. They may have negative cash flows, so no or little positive cash flows, and on many occasions those cash flows will be not negative. Now the loans, the venture debt may be provided in the form of a line of credit, or perhaps also a term loan. And realistically, venture debt is not something that you would ever see a bank do. For banks, these types of borrowers are simply just too risky. However, private debt is a lot more flexible, and we'll talk about how this may be structured. It's typically also a complement, so the debt is granted as a complement to VC funding, venture capital funding, so funding of an equity nature, equity funding. The shareholders are able to retain control, because debt funding doesn't take control away from them or decrease their control in any way, dilute it. Retain control without dilution, seeing as no further equity is issued. The amount of equity is not increased, but of course there is a high risk associated with lending to early stage companies. So these companies have negative or zero or very little cash flows. They typically don't have collateral or assets that can be used as collateral. So as a result of that, the lenders may require additional compensation for the risks being taken. For example, options or rights to buy shares in a borrowing company. And, you know, depending on the pricing of that, of those options, that may lead to dilution in the future. Right, next type of debt or private debt. This is going to be direct lending, but direct lending here can be, it's not just that investor lends to a company. This may be done, and often is done, via a specialized fund. This is like bank loans, so very classic, sort of typical traditional structure. Typically, you've got a fixed repayment schedule. Unlike with venture debt, where you have to retain more flexibility given the uncertainty of the company's cash flow generation, this is going to be senior, typically senior secured debt in terms of its ranking. There will be proper covenants to afford the lender some protection, to protect the lender. This is, you know, and this is where I, once again, don't like this definition of private debt, because it talks about private entities being the recipients of this. Well, the thing is, direct lending can also be provided to public entities as well, so we kind of go away. That definition isn't necessarily very good. It's typically provided by a relatively small number of investors to private companies, plus sometimes public companies as well, public entities, although that is not the norm, so to speak. It's the more the exception. This is different to bonds, right, which trade publicly and get issued to a huge number of investors who buy individual bonds. Well, here it's a small number, restricted number of investors who provide the direct loans, and they will definitely these investors be holding loans which do not trade in public markets. As I mentioned, direct lending is often achieved, or often sort of done via funds which pull capital from investors, and that pooled capital gets lent out, capital from investors. And this is interesting because the loans themselves may either go to companies, or they may go to PE funds who are seeking to leverage up their investments, like in an LBO. You know, you want to finance an acquisition. So to PE funds wishing to finance acquisitions of portfolio companies. So in an LBO situation, the borrowed money doesn't necessarily have to come from a bank. It may come from another fund focusing on private debt. And let me just state that the interest rate involved in these types of loans is typically going to be higher than for a otherwise similar bank loan, because this borrowing is used primarily by those companies, those borrowers, without a good alternative, without good alternatives. If they could go to the bank and borrow, they would, but typically banks are unwilling to lend to them because of their situation, because of what the money is going to be used for, or because they want the loan to contain some element of flexibility, which the bank doesn't necessarily want to go for. Now, an important word, a subtype of or subgroup within direct lending is something known as, leveraged loans. And this is a problematic phrase, this leveraged loans, because it also appears in the fixed income section of the curriculum. However, over there, when you say leveraged loan, you typically refer to a loan that's granted to a company or a high yield sort of bond issued by a company which is not necessarily, or an issuer not necessarily in the best of financial condition, with a low credit rating. That's what's meant by leveraged loan typically in the fixed income section of the curriculum, whereas here in the alternative investments, a leveraged loan is a loan which itself is levered. So what will happen is you've got a private debt firm or fund, and it borrows money and then grants, with that borrowed money, grants further loans. And these are the levered loans because they are funding by borrowing that's done by the private debt fund or the private debt firm itself. If you look at the vocabulary section or the definition section at the end of the curriculum, you'll see that levered loan and levered loans, appear as two distinct phrases. One is just the plural of the other. So effectively, the term appears twice with different definitions, which I don't think makes much sense. They don't really go and talk about it at all. So don't be confused. Although this is a good reason to be confused, right? Well, you've been warned, now you know. The third type of private debt is mezzanine debt. And just recall from 2 videos ago when I talked about private equity strategies, when we talked about VC, I said one of the VC investment sort of stages is something called mezzanine funding. That's funding given to a company before it does an IPO. Well, this is different. We're talking about mezzanine debt, and it's nothing to do with that type of mezzanine funding. It's debt which, in terms of the balance sheet and the capital structure of a company, sits in between. Whenever you see the phrase mezzanine or the word mezzanine, it's something in between, and it's the form of debt that sits between senior secured debt, so the classic traditional one often provided by banks or traditional bond investors, and equity, obviously provided by shareholders. So this is where mezzanine debt sits. And you could say, well, it's basically debt which is subordinated to senior secured. It ranks lower than senior secured. And that's absolutely fine. That is, after all, the definition of it. It's less secure, it's more risky than senior secured debt. What you have to be aware of is that it is often used, this type of borrowing, to finance things like acquisitions, LBOs, leverage buyouts, things like that, as opposed to the sort of more conventional investments that a company may be doing. So, right. The takeaway is that mezzanine debt is more risky, definitely as an investment, than your classic senior secured debt. It's more risky because it's both junior and it is unsecured. So it is junior in terms of hierarchy or of payments, and unsecured in terms of no specific collateral being pledged against it, and therefore the repayments will potentially come in the case of a liquidation from the overall residual net assets of the business, whatever is left. And because of this, it typically commands a higher, well, it has to, higher interest rate that's demanded by investors. Plus, you know, whenever you want to sweeten something that's risky, you may build into this type of debt to attract and woo investors some unconventional, nevertheless attractive and potentially favorable features like warrants, the option to buy shares in the future for a specific price, or conversion rights, the ability to convert this debt into shares of the company. This is how you sweeten what otherwise is a pretty risky investment for buyers. Right. Fourth type of private debt that you need to know, yeah, I think mezzanine was number 3, is distressed debt. Okay, this is, of course, I mean, it's not much of a, it's probably not a very, it kind of, the name is very, it kind of tells the story. This is debt typically coming from mature companies, debt of typically mature companies, so not startups, for example, which by definition are in a poor financial condition because they're not generating positive cash flows yet, but these mature companies are going to be typically in some form of financial trouble, like bankruptcy, default, or being close to default, close to bankruptcy. And you know, it will be attractive to those investors who are able to spot a company which currently is in trouble, it has problems, but they think it's temporary, and it's possible for that company to lift itself up and for the debt to increase in value. Or another possibility is, and maybe this is a name you should be aware of and know, turnaround investors, who are very much into distressed debt. These are investors who buy debt, they acquire debt securities or debt instruments to get actively involved in the process of restructuring and reorganizing a company. In company restructuring, reorganization. However, and I think I have in the past said this in one of the fixed income videos, whenever you want to, as an investor, get involved in this type of process, please remember it requires specialized knowledge of the process. Not just in one country, but the country in which the company is based. The courts, you know, will handle that process according to specific laws which apply in that jurisdiction, and it may be completely different to what an investor may be used to in their domestic market. And just some additional terms that you may come across in the exam: unitranche, as in single tranche debt, right? This is a type of hybrid or blended loan. What it involves is effectively, it's a single loan with secured and unsecured tranches, but it's blended into one instrument with one single rate of interest. Normally, the different tranches would have their own interest rates, but here it's an amalgamation. It's a combination of the two. It's a blend with one single rate of interest, and the effect is that this is typically structured. Don't ask me about the details. I really don't know how they technically do this from a legal standpoint, but it's structured ultimately that the outcome appears somewhere between senior and subordinated debt, because after all it is a combination of different types of debt tranches. And one more, last one, specialty loans. Okay, now specialty loans are obviously loans given in specific circumstances for specific purposes, and one nice example which your curriculum kind of dwells on a little bit is, e.g., loans to companies involved in litigation, so in court proceedings, to companies in litigation. Even if that litigation doesn't come to court, say you're a company and you've been accused of something, you're being sued for something by a client or a competitor, whatever, you need to raise money for your legal fees to be, represented by a good law firm. Well, you may borrow to have that funded. So this is going to be for legal fees. It's just an example. There are other situations as well. And how will you pay this back? Well, you borrow money for your legal fees in exchange for share of potential compensation awarded if it turns out that you were right. Okay. So this can be done by a company that wants to take somebody to court and accuse somebody of doing something wrong and expect to receive compensation, or a company that has been accused. Either way. Right. Let's just finish off with a few words on private debt. The sort of risk and return profile of private debt, seeing as this is what happens for every asset class in the alternative investments section of the curriculum. You have to sort of appreciate where they kind of fit in. First of all, it may provide higher returns than traditional bonds. Of course, just like private equity may provide higher returns than public equity. And this is going to be especially true this potential for higher returns when there are certain inefficiencies in the market. For example, what I talked about at the top of the video, the fact that after 2008 there is a gap, or there was a gap between, I think still is, between what companies want to borrow versus what banks, the traditional lenders, are able to borrow. That niche can easily be filled in by private debt, which reaps the rewards of it. The interest rate with private debt is typically based on an MRR, so it's typically benchmarked to a market reference rate. Let's write this down. Interest rate is typically based on a market reference rate plus, of course, a spread above that, as opposed to some kind of fixed rate loan. Now, what about the risks? Well, the level of risk really depends on basically a number of factors. It depends on stage of company in terms of the life cycle, where it is, right? It's obviously going to be higher, the risk is higher for venture debt than it is for debt to a more sort of established and mature business. What else? It will also depend on the actual debt structure, the specifics of the agreement, you know, where it sits in, how it is secured, what tranche it's associated with, etc., etc. Senior debt obviously will generate a steadier return than mezzanine debt. Mezzanine debt is associated with higher returns because it's more, it's closer to equity, and therefore poses a bigger risk. It has more of an equity type upside, especially given the fact that it's often associated with certain conversion rights. Private debt is definitely riskier than bonds. And whereas bonds are typically quite liquid, this is going to be illiquid. The borrowers involved are more risky borrowers who are not necessarily able to issue bonds or borrow in the traditional sense from banks. And just like with private equity, we as investors face the problem of a lack of quality data.